Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over Adobe stock, in which they have their earnings upcoming next week on September 11th. So I'm gonna be getting into what to expect for this next earnings report, and then I'm gonna be going over why I believe that this earnings could change everything for the future of Adobe stock. So first, taking a look at the stock in the past year, it's down nearly 40%. Right now it's trading at $344 per share, market cap of $146 billion. If you don't know what a market cap is, that's basically the valuation of the total company. If you wanted to buy Adobe, that's how much you would have to pay for the entire company. And taking a look here, it is right near its 52-week low of $330, and it's within $15 of that 52-week low. So it is trading at a pretty big discount compared to its past. But just because this company is trading at a discount compared to past values doesn't mean that this company is undervalued. But we'll be getting into whether or not I think this company is undervalued or not using my intrinsic value calculator at the end of the video. So you want to stay tuned for that at the end. But first, let's get into what Adobe is and how they make money. Adobe makes money primarily through the sale of software subscriptions and licensing. Its main revenue streams are divided into three segments: digital media, digital experience, and publishing. And if you don't know Adobe, they own products such as Adobe Acrobat, they have Premiere Pro, Photoshop, a bunch of other products similar to that where people can pay a subscription in order to use those products. So this company is a subscription-based company, and that's why I actually do like that about this company. Ever since they changed it to a subscription-based, they continue to grow revenue. Taking a look at for their upcoming earnings, for their quarter 3 earnings on Thursday, September 11th, 2025, we can see the revenue is expected to be about $5.907 billion, and the earnings per share is approximately expected to be $4.21, which could be an increase from $3.81 from the same quarter last year. So they're expecting actually some pretty good growth here. They're expecting just over 10% growth in the earnings per share, so that looks pretty good year over year. Taking a look at with the last quarter they had $5.87 billion in revenue, so they're expecting a very slight increase compared to last quarter. So they're still expecting to grow this revenue and earnings per share in the future. So this looks pretty good for Adobe for the upcoming earnings. Keep in mind if they do come in line or beat, but if they miss it, then this could be bad. But I do expect them to probably stay in line or beat. But taking a look at the key points for Adobe for the upcoming earnings, besides the financials, obviously, those are very important, but we want to look at the narrative about Adobe for this earnings. First, we want to look at the AI monetization and adoption, because Adobe has shifted their strategy towards generating AI for their platforms with Firefly, which is a crucial area to see where they are. Their investments could potentially help them grow in the future. And we want to see the growth of AI first products. We want to see if that is growing over time. Also, we want to see the monetization of new features. The company has been adding AI capabilities to its Creative Cloud products, so we want to see if that's helping the profit margins potentially, and also see if it's helping just overall the people wanting to keep using these products. And we want to see if they're starting to make money off of this AI. Also, we want to take a look at the competitive landscape compared to other AI tools out there. We want to see Adobe still standing strong, because I think that is the main reason for this stock, why it's down so much, is because of competition, number one, with other companies, number two, AI potentially taking over Adobe's business. Also, like we said, we want to see the financial guidance. We want to see updated revenue and EPS forecast for the full year. Also, we want to see the ARR, which is the annual recurring revenue in digital media, to be accelerating. Hopefully, any deceleration could be bad for this company. We also want to see the digital experience segment. We want to see Adobe's business is split between its digital media and digital experience segments. We still want to see digital experience segments continuing to grow with strong demand. Taking a look here at Adobe's competitors, which is the biggest threat to Adobe stock and the moat they have. And if you don't know what a moat is, basically it's a metaphor compared to a moat of a castle, the bigger the moat is, the more unlikely it is for someone to get into the castle. So think of Adobe as the castle, and we want to see them have a big moat where other competitors can't really take advantage of them. So with that being said, I think this is the main reason the stock has been doing pretty bad over the past year or two. I think it's mainly due to AI, obviously, but I think it's also with the competition. As we can see here, Canva is a major threat to Adobe, which is a very similar basically to Photoshop and Illustrator, and I actually use Canva for these videos, not to edit, but I do use Canva in order to make the thumbnails. Also, we have Figma, which is a dominant player in the UI and UX design space, which is a cloud-based platform to product design, has become an industry standard and was the focus of a failed acquisition attempt by Adobe. If you didn't know, Adobe tried to buy Figma for I think 20 some billion dollars. However, it did fail, and now Figma is a public company right now. So that is potentially gonna hurt Adobe in the future because they tried to acquire Figma in order for them to not have as much competition, but it didn't work. Also, we have all these other ones, but these are the two main ones. We also have in the digital experience and marketing, Salesforce, Oracle, and SAP are some big competitors, and also Google Analytics is a primary competitor to Adobe Analytics. But taking a look at the moat, I do believe Adobe still has a pretty strong moat compared to these other companies. Even though I think it might be diminishing in the future, we can see that high switching cost is their most powerful moat, meaning once you're with Adobe, you're not going to want to leave because you already have all your stuff with Adobe and you've already been paying for it and using it over time. Also, the workflow integration, they really integrate their products together with each other to make it more seamless, so that's another good thing. And also file format standardization, like I said, integration with their other products. Also, we have the network effects. The more people and companies that use Adobe, the more valuable its software becomes, because if you want to be hired, most professional places use Adobe like Photoshop or Premiere Pro. And if you want to be able to use these, you have to learn it. And then once you learn it, then you basically don't want to switch basically to any other competitor, because once you've learned it, you're already familiar with it and you like it. So you're going to continue to use it. Also, the intangible assets, they have a strong brand and reputation, but I believe that's not a huge factor with the moat. Taking a look at some positive factors for the future of Adobe, we could see potentially AI could be a positive factor with Adobe Firefly, which could potentially help them increase the amount of users using it if it becomes very well used and monetized. Also, we have a dominant market position and subscription model, which I really like about Adobe. When they changed to the subscription model, they started to see recurring revenue continuing to grow over time at a very consistent rate. So it continues to grow. The amount of paid subscribers is over 33 million. So I really like that about Adobe. But looking at the negative factors for Adobe, similar to the positive factors, we do have AI with a negative factor because of growing AI competition. A lot of other AI competitors are using AI and basically competing with Adobe and having basically costing less than Adobe, so it could potentially hurt Adobe in the future. Also, we have pricing power concerns, which the ease and affordability of new AI tools, like I've been saying, could very hurt Adobe stock and just the company in general, because as more resources come available at a cheaper price, Adobe would potentially have to reduce their margins in the future as a result of the increased competition. Also, we have slowing growth and weak outlook. Like we said, their slowing revenue growth and disappointing guidance have been having a negative factor on the stock for now and the future. But looking at what to expect for September 11th earnings, this is what I believe is going to happen. I think we're going to have slight beats on earnings and revenue. As we saw, they're expected about $5.91 billion in revenue. So I'm expecting about 5.95 is my estimate for the revenue. And for the earnings per share, I think the earnings per share will come in at about $4.25. So I think they're going to have very slight beats on both revenue and earnings. And I think we're going to have big buybacks continue. They've recently been buying back a lot. So I think they're going to continue to buy back as the stock continues to go down. Also, concerns over competition will be said on the earnings call, but I still think the company will still be resilient due to just the overall quality of Adobe's products. I think they're still going to continue to do well. Now, taking a look at my 7-step stock analysis, this gives us the key financial metrics for Adobe that I like to look at. And the first one I like to look at is the forward PE ratio. I want this less than 30, and this is basically the price of the stock divided by the earnings per share. And if we compare this to the market right now, it's at about a 25 PE ratio. But Adobe right now is trading at a 17 PE ratio. So if you bought the stock today, you'd be paying $17 for $1 of future earnings per share in the next year. So that's a pretty cheap valuation compared to the market. And also taking a look at the ROIC, which is the return on invested capital, we want this greater than 10%, meaning they're efficient at reinvesting back in the company. And as we can see here, Adobe is very efficient. 35.4% ROIC is very high, and this means that out of all the money they use to reinvest, 35.4% is returned to the company back again. So they have a really high return on investment. Taking a look at both the revenue and earnings growth, both are growing at about 13%. So taking a look here at that, we can see over time it's been growing at about 13%, but the one thing I don't like is the deceleration of growth. As you can see, over the past 10 years, it was growing 18%, but over the past 5 years, only 13%. In the past 3 years, down to almost 10%. So it is decelerating, but it's still growing at double digits. So it's nothing to be very angry about, but I'd rather see a company staying the same growth rate or accelerating, but it's still growing at a decent rate, but we just have to factor that into our valuations and pay a cheaper price. And taking a look at the shares outstanding, we want this decreasing over time. And as we can see, Adobe is buying back at about 2% each year, which is a very good rate for Adobe. And they've actually been increasing that rate faster. Taking a look here, we can see over the past 10 years, they're decreasing at only -1%. Over the past 3 years, they're buying back at over 3%. So they've really started to buy back shares as a result of the stock doing pretty poorly. And I want to see this continue to drop at even a faster rate, because I believe right now Adobe's at a pretty good valuation for the company. And if they continue to buy back, this will show confidence that the company does believe that in the future they are still set up for a good return in the future. And the reason we want to see shares being bought back is because as shares are bought back, this actually means if you own this company, you'll own more of the company as it goes on in the future. And the reason for that is because there will be less shares outstanding. But if you own the same amount of shares in the past and just stay with the same amount, you'll actually own a greater percentage, because if you divide your shares by the shares and the shares decrease, you'll actually own a greater percentage. So that's why I like to see share buybacks. Not saying that share buybacks is necessarily always good, but for a company like Adobe, I do like to see share buybacks, especially when the stock is going down. Now, taking a look at the debt to free cash flow, this is basically showing us in how many years can they pay off all their debt with the free cash flow they're generating each year. So with that being said, with this 0.65 value, this means they can pay off all their debt in 0.65 years, or basically about 8-ish months, 7-ish months, around that area. So they can pay this off in less than a year, and we want this less than 3 years. So this is pretty good for the balance sheet of Adobe. Also, now for the expected EPS growth rate, we want to see greater than 5% for analysts, and they expect them to grow at about 9% each year. And if we take a look at the growth estimates, we can see revenue is expected to grow about 8 to 9%, while the EPS is 9%. So they're expecting a high single-digit growth rate. So that is pretty much to be expected with Adobe slightly decelerating over time, and I think that makes sense. But with that being said, I'm going to be going over to my intrinsic value calculator in order to get a fair value price. But first, let me tell you about this website right here that I really enjoy a lot. And you've been seeing with all these metrics, as we can see with the historical financials, shares outstanding, and growth estimates. You also get a bunch of other things if you go to this website. And in the link in the description, you can actually get a subscription, and it's a very cheap subscription, only $10 per month, and you get 20 plus years of financials, and you get a bunch of other companies you can analyze with these financials. And I really like this. I really like it a lot. I have the premium version, and I really enjoy it. website is called PE Valuator. So I have a link in the description. And also, if you use my code Valuation Investing, you will actually get 25% off of your monthly premium. So that is pretty good. I really like this website. So with that being said, now let's get into the intrinsic value calculator. Now taking a look at my intrinsic value calculator here, I have to do future assumptions for Adobe. So the first assumption I have to do is the annual revenue growth rate for Adobe for the future. And with this in the case, I believe that Adobe will probably grow about 8 to 9%. I think analysts are basically in line with what I think, but let's do bear case 6% because I believe bearish case AI really takes over the business. The company starts to slowly grow over time, really decelerates in the next 5 years. But for the base case, I'm actually going to put 9%. Actually, let's put 8.5% because I think for the bull case, we can't have it too high because I think bull case, I highly doubt it. I highly doubt that we'll see double-digit growth for the next 5 years out of Adobe, but I guess you never know. So with that being said, for the bullish case, I'm going to put an 11% growth rate. Now for the future profit margin, taking a look at the profit margin in the past, we can see it's been basically since 2020 right around 30-ish%. So with that being said, I believe potentially, say for the bear case, there's a lot more competition, decrease in pricing power. So with the future profit margin, let's say they get to 27%, they decrease by 3% from today because of increased competition. Now for the base case, let's do 30%, right about where it is today. And bull case 33%. Say their AI Firefly really starts to help this company grow over time and really helps to increase the profit margins, then I do think that they could possibly increase that margin. But now for the future PE ratio, as we saw right now, the future PE ratio is at about 17. The trailing PE ratio is at about 22. With the company growing 6% each year, I believe with a diminishing company with not necessarily diminishing, but the competitive advantage they have diminishing, increased competition, a company growing 6%, I believe for the future PE ratio, I think an 18 PE ratio could be fair. Now for the base case, I think for this company, a 22 PE ratio would be fair. And now for the bull case, let's do a 26 PE ratio. Now for the shares outstanding, I believe since they're buying back on almost 3% in the past few years, I think that they can continue to do that, but if the stock goes up, then they might not buy back as much. So with that being said, I think bear case they'll buy back 1%, base case let's do 2%, and bullish case say they buy back at 3%. With that being said, right now I get on the bear case only a 1% return. For the base case, I get about an 11% return with, I believe, pretty conservative numbers, with pretty conservative, I think. And even if they bought back at 3%, which they've been doing, you could get 12% return. But I think you can definitely potentially outperform the market with Adobe as long as their competitive advantage continues to increase and not diminish over time, and their moat doesn't diminish. And then for the bullish case, 21%. Me personally, I have not bought Adobe yet. And the only reason I haven't bought it is because I'm slightly worried about the competition going forward with Adobe. And honestly, it's not even necessarily about AI. I honestly think AI could potentially even help Adobe for the future. But my biggest concern is competition. I don't like buying companies that don't have a great moat. But in the past, Adobe did have a very good moat, but now it is slightly diminishing, but I still think they have a decent moat. But nonetheless, I personally am not buying this company yet. Like I said in the past, if this company got under, say, $300, I think I would buy this company. So if we put in $300, I think you can make almost 15% pretty conservative. So if it somehow gets to $300, I'd be buying. But I do think that if you are willing to take some risk with this company potentially diminishing with their moat over time, I think you could still make a good return and potentially see very good gains in the future. So with that being said, please subscribe, please like, comment down below. Thank you guys for watching this video, and see ya.